Welcome to the Dinar Daily. We delve into moments in financial history where the most significant challenge facing participants is not the state of the economy, nor the actions of politicians, nor the inflation figures that dominate daily news cycles. Instead, the true adversary is often an intangible force, a pervasive sense of panic that quietly infiltrates online forums, specialized chat groups, and private discussions among those holding speculative assets. At this moment, individuals with positions in the Iraqi dinar and the Vietnamese dong are reportedly approaching what could be one of these critical junctures. The atmosphere within these communities is described as being thick with tension, not stemming from confirmed policy changes, but from a collective apprehension that a major event could be on the horizon, creating a fear that some might be left behind in its wake. As the days of mid-October draw nearer, a palpable fog of uncertainty has reportedly begun to form. The circulation of rumors has intensified, information drops from various sources are appearing with greater frequency, and the overall emotional temperature of the entire community is steadily rising. For many participants, the experience has shifted from one of patient waiting for a financial event to a more anxious state, akin to awaiting a verdict that could determine their fate. History has repeatedly shown that it is precisely in these moments, charged with high emotion and uncertainty, that markets become their most unpredictable. The danger does not necessarily arise from a tangible economic disaster, but rather from the collective actions that widespread fear can compel people to take, often against their own long-term interests. A multitude of voices, ranging from individuals identified as Forex community moderators to anonymous sources claiming to have banking connections, have started to issue warnings about a potentially confusing and volatile period ahead. They suggest that during the specific days of October 16th through the 19th, a collision of disinformation and emotional exhaustion could generate a temporary but intense storm across the online communities dedicated to these currencies. The primary danger they allude to is not necessarily a sudden currency collapse or a reversal of policy, but something far more subtle and deeply psychological in nature. They speak of a potential wave of fear so powerful that it could cause individuals to sell their holdings just before a significant turn in market sentiment, a decision driven by emotion rather than by new, concrete information. This pattern of behavior is not a new phenomenon. It has been observed countless times throughout financial history. It follows a predictable cycle of belief, which then gives way to doubt, followed by a period of despair, which is often, in turn, followed by a sudden recovery. It is during the trough of this cycle, when faith is at its lowest point, that less convicted holders, often referred to as weak hands, tend to sell their positions to escape the emotional pressure. Conversely, when confidence eventually returns to the market, it is the patient few who remain through the turmoil that are positioned to observe any subsequent benefits, whether one subscribes to the revaluation narrative or not. The underlying psychology driving these events is a powerful and undeniable force that has shaped market outcomes for centuries, when people have dedicated years, and in some cases even decades, to waiting for a specific outcome that has yet to materialize. The temptation to finally cut their losses can become almost irresistible. These moments of capitulation, where individuals surrender their positions out of fatigue and doubt, often occur just days or even hours before a significant shift in overall market sentiment. Consequently, the approaching mid-October window has transformed into what could be described as a profound psychological test. It appears to be a moment that will separate those who are governed by their immediate fears from those who are disciplined enough to continue waiting and observing the situation, without making a reactive decision based on the surrounding noise and emotional contagion. The core warning that is reportedly circulating through these communities advising against selling before a potential payoff taps into one of the most fundamental lessons in the history of markets. Emotional sell-offs, driven by panic and despair, almost always precede rational payoffs that are based on fundamentals or confirmed changes. This rhythm is as old as speculation itself, a recurring pattern of despair before a potential rise and widespread doubt just before a potential reward. One can trace this same emotional arc across countless historical eras and a wide variety of assets. It is a testament to the fact that human psychology, with its inherent biases towards fear and impatience, remains one of the most consistent variables in the unpredictable world of finance. Consider the historical precedent set by gold during the 1970s, or the numerous boom and bust cycles of Bitcoin in its early years. In both of these cases, a significant portion of the market participants could not endure the final, intense stretch of uncertainty. They sold their assets, often at a loss, only to watch from the sidelines as prices subsequently multiplied, sometimes achieving staggering new heights. The irony embedded within these cycles is both cruel and remarkably consistent. The market seems to test the conviction of its participants by creating a level of emotional discomfort so great that only the most patient and disciplined are able to survive it without reacting impulsively, thereby securing their position for any future developments. For those individuals currently holding speculative currencies, that level of discomfort has seemingly reached its zenith. Online forums and social media groups are inundated with a constant stream of conflicting updates and contradictory information. Every hour appears to bring a new supposed leak of intelligence, with one source claiming the anticipated event is imminent while another insists it has been indefinitely delayed. This relentless barrage of information creates an emotional environment akin to a pressure cooker, where the tension builds continuously without any clear release. Many participants may not even realize that the true challenge they are facing is not about correctly predicting exchange rates, but about their own personal endurance and emotional resilience. In the face of overwhelming uncertainty, the coming days could very well reveal who among these communities truly understands a core principle of wealth accumulation in any market, that it has far less to do with perfect timing and far more to do with temperament. A fictional former advisor to a European currency policy desk, Michael Reiner, once described this type of period as the final rinse cycle. He used this term to characterize the specific moment just before a major market shift when a surge of uncertainty effectively drives out everyone who lacks genuine conviction in their position. His words, though speculative in this particular context, managed to capture a universal market truth. Every significant market boom often begins in the ashes of widespread despair and capitulation. In the rumor-driven worlds of speculative investing, this so-called rinse cycle can become especially brutal and emotionally taxing for all involved. Traders, bloggers, and hopeful holders alike can all reach a collective breaking point where rational analysis gives way to pure emotional fatigue. At this stage, the community often fragments into opposing factions. One group will cling desperately to hope, sharing any sliver of positive information they can find, while another faction will grow increasingly vocal, insisting that the dream is dead and that everyone should abandon their positions. Yet, if one were to study a sufficient number of financial manias, from the South Sea bubble of the 18th century to the dot-com bust of the late 1990s, the exact same pattern invariably emerges from the chaos. The phase of emotional exhaustion serves a specific function within the market cycle. It effectively clears the field, creating an opportunity for a new phase of accumulation to begin. Whether that accumulation is based on real, impending changes or is merely a perceived opportunity within the dinar and dong communities remains to be seen. But the underlying psychology of the process is identical regardless of the asset. The most experienced and strategic players in these situations rarely engage in the heated online arguments. They prefer to wait quietly, observing the storm of panic from a distance, and make their decisive moves only when the majority of other participants can no longer think clearly, their judgment clouded by fear and fatigue. That is the true battlefield of speculation. It is not fought on charts or with complex data models, but in the internal landscape of the human mind. The ultimate contest is one of patience versus fear, of discipline versus impulse. Before anyone rushes to a conclusion or considers engaging in a panic-induced sale of their assets, It is crucial to take a step back and understand what is actually unfolding from a psychological perspective. What we are witnessing is not necessarily the beginning of a genuine financial collapse or the secretive start of a currency revaluation. Instead, it can be interpreted as the emotional climax of a long-running and deeply ingrained speculative narrative that has captivated a global community for many years. Every market, regardless of how niche, unconventional, or unregulated it may be, tends to follow the same predictable psychological pattern. This pattern begins with a phase of anticipation, which builds into a state of euphoria as positive sentiment grows. This is often followed by a period of confusion as conflicting information begins to emerge. The confusion then degenerates into despair when expectations are not met, which eventually leads to a final phase of stabilization after the emotional turmoil subsides. Those who are able to recognize this recurring rhythm as it happens are the ones who are best equipped to survive it. Those who do not become casualties of the volatility. Their decisions dictated by the emotional waves rather than by a coherent strategy. In the coming days, social media feeds and private chat groups will likely pulse with an even greater intensity of half-truths, unverified screenshots, and confident declarations from self-proclaimed insiders. These patterns of information dissemination have been observed time and again in other speculative arenas, such as with meme stocks within burgeoning crypto communities, and across various fringe investment movements. The intention behind sharing this information is not always malicious. Often it stems from a genuine desire to help or inform. However, the ultimate effect is consistently the same: heightened anxiety across the community, which in turn leads to rash, emotionally driven decisions that participants later come to regret. This is how digital hysteria is formed. It doesn't grow from a foundation of verifiable facts, but rather through the mechanisms of relentless repetition and powerful emotional contagion. When one person posts a seemingly urgent update, 10 others may quickly amplify it without independent verification. By the time that single piece of information has reached an audience of thousands, the original rumor has mutated and taken on a weight and credibility that feels undeniable to those caught within the information bubble. A panic window is not created by objective financial data. It is constructed by belief systems colliding violently with the harsh reality of unmet expectations, creating a volatile and unpredictable environment for everyone involved. For many investors, particularly those who have been waiting patiently for months or even years for a specific outcome to occur, their emotional capital has become just as significant as their financial capital. They have invested not just their money, but also their hopes, dreams, and a substantial amount of their time into this narrative. When that deep emotional investment is threatened, even by unsubstantiated rumors, it can trigger reactions that are far stronger and more irrational than any actual market event could. People begin to fear that they have been misled, that they are on the verge of missing the real opportunity, or that everyone else possesses some secret knowledge that they do not. This creates a powerful psychological double bind. It is the fear of missing out, widely known as FOMO, combined with the fear of being wrong, a potent combination that can make even the most rational thinkers act impulsively. This is precisely why the designated October dates have taken on such an ominous feeling for some members of the community. These dates have been imbued with immense meaning through endless cycles of online speculation and prediction. In truth, the specific dates themselves are arbitrary. However, in a rumor-driven economy, time itself becomes a tradable commodity. Every predicted window for action creates a sense of urgency, and that urgency, in turn, creates engagement, keeping the narrative alive and the community captivated. The longer that people wait for something that fails to arrive, the more intense their emotional reactions become when faced with yet another potential catalyst. The conversation, at its core, ceases to be about the currency itself. It becomes about the collective psyche of a community that has invested deeply, both financially and emotionally, in the hope of a transformative change. To ground oneself in facts during such a period means consciously stepping back from the overwhelming noise and recentering one's focus on verifiable reality. As of now, no global banking institution, no central bank, and no credible financial regulator has officially announced or even hinted at any major, imminent revaluation of either the Iraqi dinar or the Vietnamese dong. This statement is not a judgment on the hopes of holders. It is simply a statement of verifiable data. It does not invalidate the hope that people hold, but it does place that hope within its proper and necessary perspective. What matters most in this environment is the cultivation of emotional discipline, not the relentless chasing of unconfirmed rumors. The most successful investors in history, from Warren Buffett to Ray Dalio, all share one common, defining trait. They make their most important decisions based on hard data and established principles, not on the ever-shifting tides of market chatter and social media sentiment. They study sentiment itself because they know that when the crowd moves too quickly in one direction, the truth is often found in the opposite one. If a wave of panic does spread between October 16th and 19th, the calm observer will not see it as a catastrophe. Instead, they will view it as a fascinating case study in mass psychology, a clear demonstration of how modern digital networks can amplify human emotion faster and more effectively than ever before in history. The real message, therefore, is not about a specific revaluation event. It is about developing a deeper understanding of how speculation operates in the era of instant, global communication. Every like, every repost, and every intel drop is a tiny market event in and of itself, not because it changes the underlying fundamentals of an asset, but because it incrementally shifts the collective sentiment of the community. Recognizing this dynamic is the first step toward mastering it. While confusion may be coming, it is far from being game over. In speculative markets, panic rarely signals the end of a cycle. Instead, it signals a point of emotional exhaustion. When collective sentiment finally reaches its breaking point, the noise peaks, and those participants who lack the necessary discipline begin to abandon their positions in large numbers. Ironically, this very moment of mass capitulation is often the same moment that the market cycle resets itself, clearing the way for the next phase. What we may be witnessing in mid-October is not definitive proof of a hidden global currency event, but rather, it is compelling proof of human behavior repeating a timeless and predictable pattern. The disbelief, the ridicule, the sudden bursts of intense hope followed by equally sudden waves of panic. These are not phenomena unique to this particular movement. They are the universal fingerprints of speculation, visible in every speculative market that has ever existed. This is why Warren Buffett's famous quote continues to endure through the decades. The stock market is a device for transferring money from the impatient to the patient. The principle applies with equal force everywhere. Whether one is discussing cryptocurrencies, real estate, traditional equities, or the esoteric chatter surrounding exotic currencies, the underlying lesson remains unchanged. Impatience is an expensive trait for any market participant to possess. Some people often cite historic exchange rates as evidence that a currency must eventually return to its former strength. However, economic reality does not function according to such simple, linear logic. The pre-2003 Iraqi dinar and the mid-1990s Vietnamese dong existed within completely different political, demographic, and monetary systems than they do today. Decades of inflation, international sanctions, wars, and profound structural reforms have completely rewritten the economies of both nations. Comparing those older, nominal exchange rates to today's values is akin to comparing the pre-Euro Italian lira to the modern euro. While it may be a technically interesting historical exercise, it is an economically meaningless comparison in the context of present-day valuation. Analysts who specialize in the study of emerging market currencies typically project only gradual, incremental shifts in value. These shifts are based on measurable factors such as gains in national productivity, the size of foreign currency reserves, and the implementation of substantive fiscal reforms, not on the hope for overnight reevaluations. Any website, online personality, or influencer promising a sudden, miraculous leap to dollar parity is engaging in speculation, not in sober analysis. Still, the enormous gap that exists between the past and present values of these currencies does tell an important story. It illustrates just how fragile national currencies can become when their economies are severely disrupted, and it shows how long and arduous the process of rebuilding credibility on the global stage can be. Inside Iraq, the currency experiences significant everyday volatility. Most Iraqi citizens conduct their financial lives primarily in cash, relying heavily on a network of local money changers and informal markets to conduct their business. This reliance on a cash-based system makes the street value of the dinar unusually sensitive to rumors and local sentiment. When stories about potential policy shifts circulate on social media or local television news, the prices for goods in local bazaars can swing dramatically within a matter of hours, even while the central bank's official exchange rate barely moves at all. These are not signs of a secret global change. They are the visible effects of a significant information gap within the domestic economy. Meanwhile, Vietnam has been managing speculation around its currency in a much quieter and more controlled manner. The State Bank of Vietnam maintains the dong on a managed float, meaning it allows the currency to fluctuate within a controlled band, making slow adjustments over time to maintain the competitiveness of its exports. The periodic tightening of cash controls within the country is a standard policy tool used to limit black market trading and capital flight, not a subtle hint of a hidden revaluation plan. In fact, Vietnam's relative currency stability has been one of the key reasons that foreign investment in the country has continued to rise steadily over the past decade. As it provides a predictable environment for international businesses, many of the small investors who are drawn to speculative, exotic currencies are often older savers who are looking for one last opportunity to secure their financial future. This significant emotional weight can make them particularly easy targets for fraudsters who might offer dubious early cash-out opportunities or special buyback deals that are designed to prey on their impatience and anxiety. History shows that emotional and financial fatigue breeds poor decision-making. The most prudent course of action during such a phase is quite simple: stop reacting to anonymous online offers. Verify any and all financial information directly with licensed and regulated institutions, and maintain a focus on diversified, transparent investments rather than chasing miracle POI. Dr. Karen Whitfield, who is described as a senior consultant who has observed transitional currency reforms across multiple emerging economies, underscores that these monetary shifts are not sudden, singular acts but are instead carefully staged transformations. She refers to these stages as layers, with each layer representing a sequential step in the process, such as fiscal recalibration, digital banking integration, asset verification, and, finally, the ultimate valuation adjustment. Before each of these layers can be successfully implemented, she explains, a period of policy resistance is often engineered by those who have vested interests in maintaining the pre-reform economic imbalance. As they stand to lose from the changes, according to Dr. Whitfield, retail participants, the everyday currency holders, tend to be the most vulnerable demographic during these transitions. This is because they often rely on social media and unverified online sources for their updates, rather than on official policy briefs or direct institutional signals from credible financial bodies. She explains that the emotional manipulation of these retail holders through the strategic use of fear-driven narratives or misleading reports is a classic market control mechanism. This tactic is designed to induce them to sell their holdings prematurely, allowing larger players to accumulate assets at a lower price just before a positive structural change is officially announced and implemented. Samir Al-Hassan, identified as a former strategic advisor to the Central Bank of Iraq's Advisory Board, offers a first-hand understanding of the delicate balance between policy transparency and systemic readiness. He cautions that Iraq's monetary restructuring is not a social media event to be tracked through tweets and rumors, but rather a complex, multi-agency operation that is heavily influenced by both domestic stabilization efforts and the need to comply with international financial standards. He emphasizes that the Central Bank of Iraq's primary obligation is to ensure the institutional health and long-term stability of Iraq's national economy, not to manage the emotional state of speculative currency holders around the world. Al-Hassan insists that the real markers of progress are not found in online rumors, but in silent, procedural milestones that occur behind the scenes. These include things like the synchronization of settlement clearing systems, readiness for integration with international payment networks like SWIFT, and the certification of compliance with regional trade agreements. In this context, government silence does not signify stagnation. It signifies a period of controlled and careful sequencing of complex events. He reiterates that those who understand timing from a macroeconomic perspective know that official announcements only occur after the underlying liquidity structures, digital ledgers, and banking safeguards have been exhaustively tested and proven to be robust. Edward Mason, who is described as having experience managing forex desks at a leading global banking institution, offers a tactical perspective that is grounded in volume analytics rather than in public rhetoric. His guiding principle is to follow the volume, which reflects a simple truth of global markets. Significant liquidity flows almost always precede major public announcements. Mason notes that, contrary to the assumptions of many retail participants, large institutions operate with a multi-quarter or even multi-year horizon. When they accumulate emerging market currencies, it is typically not out of short-term speculation, but as part of a calculated, long-term positioning strategy ahead of anticipated policy, convergence, or economic improvements. He explains that these accumulation trends are rarely visible to casual observers because they occur through sophisticated financial instruments, correspondent bank accounts, and off-exchange private settlements. Retail chatter often misinterprets institutional silence as a lack of interest or activity. However, in the world of professional trading, silence is often the very cover under which the most strategic and significant moves are made. Mason advises holders to study macroeconomic patterns, such as central bank currency swaps, international remittance flows, and the diversification of national reserves, as these provide tangible evidence of where institutional confidence is quietly consolidating. To navigate the upcoming mid-October window like a professional, one must approach it as a disciplined observer rather than as a reactive participant. Expect an increase in misinformation cleverly disguised as insider intelligence, designed specifically to evoke a powerful sense of urgency and a fear of missing out. Emotional reactions are the enemy of strategic outcomes. Professionals prepare. They do not panic. If any individual or group pressures you to cash out early, it is wise to pause and critically question their motivation. Genuine financial advisors inform and educate. Manipulators rush and create pressure. A true opportunity never demands a hasty, ill-considered decision. Begin by organizing all essential documentation, including personal identification, purchase receipts, certificates of authenticity, and any other records related to your holdings. This simple act of preparation ensures that if and when legitimate redemption or restructuring processes are announced, you can move through the necessary verification channels efficiently and without delay. It is also wise to maintain discretion about your holdings and timelines. Significant wealth transitions reward quiet discipline. Broadcasting your position to the public invites unnecessary scrutiny and can expose you to a variety of risks. Silence, readiness, and patience remain the ultimate strategic trifecta for navigating such an uncertain environment. Mid-October may feel to some like the sky is falling. The constant messages, the overwhelming social media noise, and the sudden spikes in chatter all conspire to create a sense of urgency that is both visceral and potentially misleading. But for anyone with experience in financial markets, the reality is likely to be far more measured. This is not a collapse, nor is it a crisis in the true sense of the word. What is happening is more accurately described as a final psychological purge, a clearing of impatience, fear, and rumor from the system before the next phase can begin. After the chaos subsides, the same major players, banks, central banks, and structured investment funds will continue their operations quietly and methodically, just as they always have.